Many investors believe the highest dividend yield automatically leads to the highest retirement income. History suggests the opposite. Some of the strongest passive income portfolios of the last decade weren't built around the highest yielding assets. They were built around businesses and funds capable of consistently increasing their dividends year after year. The difference is enormous. A portfolio yielding 8% today, but growing very little, can eventually be overtaken by a portfolio yielding just 2% or 3% that compounds its dividend stream at double-digit rates. The real question isn't how much income your portfolio generates today. It's how much income it will generate 10 years from now. And that's where most investors make their biggest mistake. So, what would the ideal dividend growth portfolio look like in 2026? The foundation of many dividend portfolios begins with SCHD. The fund focuses on companies with strong balance sheets, healthy free cash flow, and established dividend histories. SCHD currently offers a yield around the low to mid 3% range while maintaining a very low expense ratio of approximately 0.06%. Its combination of income and dividend growth has made it one of the most popular dividend ETFs available. This is not simply a yield fund. Its screening methodology emphasizes quality and profitability, helping investors avoid many traditional dividend traps. The result is a portfolio that can generate meaningful income today while still providing long-term dividend growth potential. But what happens when we add an ETF focused even more aggressively on dividend growth? VIG takes a different approach. Instead of prioritizing current income, it focuses on companies that have consistently increased dividends for at least a decade. This leads to lower starting income, with yields often around 1.5% to 2%, but potentially stronger long-term compounding characteristics. Many of its largest holdings are dominant businesses with powerful economic moats. These companies often retain substantial earnings for future growth, while steadily rewarding shareholders with increasing dividends. The result is a portfolio designed for investors who care more about future income than immediate income. And over a decade or longer, that distinction can become extremely important. Yet even VIG leaves one question unanswered. Can investors achieve a balance between income and growth? DGRO sits directly between SCHD and VIG. Its methodology requires dividend growth while also emphasizing sustainability through payout ratio screening. The ETF currently carries a yield around 2% with an expense ratio near 0.08%, offering a blend of current income and future growth. One of DGRO's greatest strengths is diversification. With hundreds of holdings, investors gain exposure across multiple sectors without becoming overly dependent on a small group of companies. That diversification can improve portfolio resilience during periods of economic uncertainty. But there is still one more layer that can strengthen a dividend growth portfolio. Noble focuses on one of the most exclusive groups in investing: Dividend Aristocrats. These are companies that have increased dividends for at least 25 consecutive years. That requirement creates an automatic quality filter. Businesses capable of raising dividends through recessions, inflation cycles, financial crises, and market volatility have demonstrated exceptional durability. While the yield is not the highest, the consistency can be attractive for investors seeking portfolio stability. The ETF essentially acts as a quality overlay on a dividend growth strategy. And when combined with SCHD, VIG, and DGRO, it creates an interesting portfolio architecture. But how should the allocation actually look? A balanced dividend growth portfolio could look like this: 40% SCHD, 30% VIG, 20% DGRO, 10% Noble. SCHD serves as the income engine. VIG drives long-term dividend growth. DGRO provides diversification and balance. Noble adds an additional layer of quality through Dividend Aristocrats. Together, the portfolio avoids excessive concentration while maintaining exposure to dividend growth leaders. More importantly, it avoids the dangerous temptation of chasing the highest yield available. And that discipline can become extremely valuable during the next market downturn. Let's consider a hypothetical scenario. An investor starts with $100,000 and contributes an additional $500 per month. Assuming a long-term total return near 9% annually and consistent dividend reinvestment, the portfolio could potentially grow beyond $300,000 over the next decade. But the more interesting number is income. If dividend growth continues at historical ranges, annual dividend income could increase significantly without requiring additional yield chasing. This is the true power of compounding. Yield on cost rises, passive income grows, and retirement income becomes increasingly self-sustaining. The portfolio begins working harder each year without requiring investors to take additional risk. But every strategy has weaknesses. The biggest threat to dividend investors is not volatility. It is yield chasing. When investors prioritize yield above business quality, they often end up owning companies with weak free cash flow, excessive payout ratios, or deteriorating fundamentals. High yields frequently signal elevated risk rather than superior opportunity. Another overlooked danger is concentration risk. Even strong ETFs can become heavily exposed to specific sectors or themes. Finally, investors must remember that valuation still matters. Paying too much for quality can reduce future returns. The goal is not maximizing income today. The goal is maximizing sustainable income growth over decades. And those are two very different objectives. The perfect dividend growth portfolio for 2026 is not built around the highest yield. It is built around quality, diversification, free cash flow strength, dividend growth, and long-term compounding. By combining SCHD, VIG, DGRO, and NOBO, investors gain exposure to multiple approaches within the dividend growth universe, while maintaining portfolio resilience. The result is a strategy designed to generate rising income streams for years to come. Which of these 4 ETFs would be the largest position in your portfolio and why? This content is for educational and informational purposes only and should not be considered financial advice. Always conduct your own due diligence and consult a qualified financial professional before making investment decisions.